The original CARES Act proposition was perfectly reasonable given the fact that we had no idea what we were going into. It was essentially a black hole. We didn't want to end up in an extended 5 to 7 year recession, or a W-shaped recession or anything like that. So we pumped in $2 to $3 trillion into the economy. But we've changed things. We've pushed ourselves into a good position, and now we've got to let off the gas a little bit, let ourselves go into a few, micro recessions over the next few years, and everything would be okay for the most part. But the Fed essentially kind of doesn't want to admit they're wrong, and they are most likely going to keep rates low for the next 3 to 4 years. And the reason is, in the past few recessions, well, actually every single recession, the Fed has never raised rates for the most part for at least 4 years for every single one of them. And so as the situation is evolving, the answer and the solution should be evolving. Now that we've put ourselves in a good position, things should be changing, but they aren't. And because of that, I think a few things are going to happen, and that's what I'm going to talk about in this video today. So last spring, around March, we had pumped more money into the economy in 6 weeks than we have the entire time between 2009 to 2018 after the housing crash between 2006 and 2008. And now on top of that, we're going to double that number, even though we've already pulled ourselves out of the mini recession that we went into for a quarter or two. And the proof of this is the fact that retail sales have grown at about 3% a year on average, but right now they're 5 years ahead. We've pushed them 15% up. Housing prices have shot up. Every industry that's open has essentially blown through the roof. What also happened last spring, or in 2020, is right when we initiated that CARES Act, we had a ton of foreign money and foreign investors dump all of their US Treasury notes and bonds and a lot of the mortgage-backed securities. And the reason is because they know that with the CARES Act and with the pumping of money into the economy, that the prices and the value of those treasury notes and bonds and everything were going to go down due to inflation going up. Now, essentially the question right now is whether or not that inflation is what the Fed likes to call transitory or not. Now, to give you an idea of what I think, 2 billionaires that have made more money than the entire lower 50% of the population over the past 50 to 60 years, every single major economist and pretty much everybody with a brain has agreed that it's not transitory. And the Fed, that has instituted monetary policy for the past 50 to 70 years, even though it's never proved that it's worked, and there's data to show that it doesn't work, thinks that it is transitory. Now, what they mean by transitory is that, for example, if housing prices and everything goes up in this industry, in real estate, then they think that as hospitality and travel opens up, that those prices are going to level out and they're going to, bring down inflation. They know that inflation is going to be a little bit high no matter what, even if it is a little bit transitory. So the second question on top of whether or not it is transitory or not is essentially how transitory it is. If housing prices are up here, they open up travel and hospitality. Is housing going to, if housing was here at the beginning of COVID, now it shot up here, is housing going to drop down to just like 5% higher than it was before, and all of these are going to pick up to that level? Or is housing going to stay up here? So that's the second question, is kind of how transitory is it? Now, my answer to that is, I think if we stopped now while we're ahead, it would essentially be moderately transitory. It would only have, we would be going into, we had a huge thing happen, so no matter what, everybody across the world is going to have problems. We would be going into back-to-back recessions for a little bit, and, they would be moderate drops. But essentially what we're doing now, because we're not changing the formula to, to answer basically the new problem of stopping inflation. Instead, we're keeping the same answer that we had a year ago. There's no new answer to it, and we're pumping and asking for another $3 trillion. It's going to cause things where you have essentially more and more money coming into the economy, but you're only more and more so. For example, if you give people $57,000 tax free, that incentivizes them to stay home. So it doesn't matter how much money you then pump into the economy, because you're promoting and incentivizing inefficiencies. That's one inefficiency. Second inefficiency is that if you make it so that interest rates are super low and everybody can take out as much money as they want for as cheap as possible, that makes it so that they're more risk prone. They're going to over leverage themselves. They're going to be starting more and more inefficient businesses. Tech companies are going to be taking on more and more debt, and other pretty much every corporation is going to be taking on as much debt as they can for as cheap as possible, and driving a lot more of these kind of zombie companies that we have, which in the short term is good because it helps prop up the jobs and prevent, deflation by maintaining the amount of jobs we have in the economy. But in the long run, it makes us weaker as an economy in total in the long run. And essentially, all of these things that we're doing, all we're counting on is essentially the fact that we're the reserve currency, which means that the rest of the world basically uses us kind of to hedge against inflation themselves, and they use us to kind of back and maintain the value of their assets and stuff like that. And so we're basically just counting on the fact that hopefully we maintain that over the next 10 to 15 years. Now, anything can happen, but I'm going to lay out, for example, one scenario as to why we may not maintain that status in the long run. So if we're already doing well, and then you pump another $3 trillion into the economy, pretty much everybody knows that it's going to cause quite a bit of inflation. Yes, the Fed thinks it's going to be transitory, but everybody else knows for the most part, for example, Warren Buffett, that it's going to have pretty profound inflationary effects. For the data shows that there's a 1 in 4 chance that we'll have at least 1 year where we break above 5% inflation, even though the target goal for the Fed is 2%. And then we're probably going to have a few years of 3.5% to 4.5% inflation. Now, across the board, once the Fed realizes this in 12 to 36 months and they admit that they were wrong, across the board, everybody agrees, the economists, the billionaires, the Fed, that hyperinflation is bad. So basically, once they get on board with what the data is showing and what the economic models show, then what they're going to do is they're going to pump the brakes. And they're probably going to do it pretty hard by raising rates a lot. So, for example, if they were to raise the rates on the US Treasury notes to 4%, which means that mortgage rates and everything needs to be a few percent higher than that, then essentially we need about 30% of our entire GDP, basically 30% of all the money and money that we're producing, in order to pay off the debt on those Treasury notes. So we're not going to be able to do that through what's called fiscal policy, for example, raising taxes and stuff like that. They are going to raise taxes in order to try and help, and they're going to tax the rich more and more, but it's not going to be enough. So then what they're going to need to do is monetize it. And what that means is they're going to have to print more money in order to pay off the debt on their debt, basically. They're going to need to print a bunch of money in order to pay that 4% interest rate that they've now raised everything to, in order to pump the brakes on the economy, which is further going to devalue those Treasury notes and devalue the mortgage-backed bonds and devalue the dollar, and then hence it's going to come back over to those two things again, because as the mortgage-backed bonds and the US Treasury notes are based on the US dollar. So as you devalue the dollar, then you also subsequently devalue those two things, which makes the foreign investors dump our treasury notes and our bonds and everything and securities that they have more and more. And then essentially, uh, you have a situation where the Fed is also on top of that in order to pump the brakes. They're purchasing, so they're printing the money, they're purchasing the treasury notes, they're purchasing the bonds, and then they're basically burning everything. They're burning all that stuff, all the cash that they purchased. So now essentially they're slamming the brakes on the economy. And then to jumpstart it again, once they can get their balance sheet back to around 2 trillion, they're going to go back to their original playbook of, hey, let's try and lower rates again, and then if that doesn't work, let's pump more money into the economy. And you get stuck in this liquidity trap. And at the end of it, in 10 to 15 years, you end up with a US dollar that is worth a monumentally lower price than it is today, a way bigger wealth gap, a lot of interconflict between the wealthy and all of the people that weren't able to purchase real assets from last year until the next 2 years, and then they got priced out of the market the second that the government, the Federal Reserve, raised the rates. Because if they raise the rates to 2-3%, and now all of a sudden the mortgage rate and the down payment and everything you need, the mortgage rate goes up to 6% as opposed to 2 or 3 that it's at right now. Now you have a widening wealth gap. Everybody on fixed income isn't able to basically survive because the value of their dollar's been going down and down, and usually people on fixed income don't have a ton of real assets that are inflating with the value of the market. And on top of that, you have countries like China that are, supposedly not trying to take our reserve currency status, but they are blocking, Bitcoin, Ethereum, stuff like that, all of these cryptocurrencies, establishing the digital yen that matches the price of their yuan, that matches the price of their physical yuan, and makes it super safe and super stable and able to easily be transferred between different countries. Same thing with India, they're also doing the same thing. And on top of that, China has $3 trillion worth of our debt purchased that they could dump, further devaluing our dollar. So this essentially propositions them for the ability to be able to possibly take our reserve currency status in 10 to 15 years. Now obviously anything could happen. People could start putting more money into, Bitcoin, Ethereum in the US and these other countries, and that could essentially be the new quote-unquote reserve currency. But right now, essentially, all that the Federal Reserve has to do is just pump the brakes now, send ourselves into a few kind of moderate recessions over the next 5 to 7 years, and that will help us not have intergenerational negative consequences at the end. So yeah, that's about it. Let me know what you guys think down in the comments. Let me know if you have any data that you can find on why the inflation would be transitory. I'd be interested to see it. And make sure to like, comment, subscribe. I'll see you guys next time.